Okay. All right, here we go. Welcome everyone to All In on Real Estate. I'm your host, Aaron Goins. I started this meetup because when I was in the military, no one in my circles talked about real estate. A lot of times we talked about debt and other finances, but nothing about real estate. So I wanted to start a meetup where people can learn about real estate and start building generational wealth with them and families. So I'm very, very excited for our guest speaker, Amy Tiemann, to be our guest speaker today. How you doing, Amy?
I'm good. How are you, Aaron? Good to see you. Thanks
Good.
for having me. Apologize on the time thing, but I'm here. So we're all good.
Oh, it's all good. It's all good. It's all good. I'm just happy you're here, and I can't wait to dig in. So I'm going to start right away with my first question to everybody. And I already know the story, but let everybody else know, how did you get into real estate and why?
Okay, so my story. So back in 2003, I started a construction company with my husband at the time, and we built that company to be a national commercial construction company. So we, over time, in 2014, we were in 16 states building retail stores. That was generally our bag. But along that journey of building retail stores in 2008, we had started real estate investing because at some point, every GC, they all end up doing it. Like at some point, become a house flipper. And so we started flipping homes and then got into single family rentals, and then got quickly after we did our first couple of single family rentals, we got into multifamily back in 2010. And then just kept going. And so we officially retired from construction for other people in 2015. And then I got divorced from my husband in 2017, but I just kept going. So I am a real estate developer. I am a multi-commercial real estate investor. I put deals together. I buy large projects, and I put the deals together and I rehab them. And so generally the deals that I buy are all ones that need love, because I buy ugly and make it pretty. And it's just kind of the skill set I've gained over the years of my starting in 2008 to today, 14 years. That's all I've ever done. I've bought ugly and made it pretty. So the same kind of thing on the commercial side, I do the same thing. So it's a very specific skill set, and I've learned that and honed it, mastered it over 14 years. So that's just me. That's how I got from A to B to C or whatever it might be. But yeah, that's who I am.
So what has been the funnest part for you in your journey, in this real estate journey?
The most fun I have is when, I'm sorry, I'm going to do that. I'm going to carve. The most fun I have is when I go into a property and I've started to rehab it and I make it safe. And that's my whole mission, right? So I'm buying from slumlords who don't take care of properties. I go and buy from people who either they're intentionally not taking care of the properties, or they just don't know how to run property and it goes into disrepair. Do they intend for it to go there? No, but they run out of money because they don't know how to run property, right? So I'll buy from knuckleheads and slumlords, basically. And what I do and what becomes my mission when I go buy these properties, because I'm dealing in workforce housing. I'm not dealing with a Class A, really nice property where people paying $2,000 a month rent for a one bedroom. That's not where I hang. I'm in, the people that work for me, they rent from me, they're construction workers, they're waitresses, they're, the salt of the earth, right? So I will go in and I'll go buy a property, and I will, the best thing for me is I've gotten tenants when I walk onto the property after we've done a lot of our construction, and I'll get tenants going, "Are you the owner?" And I'll go, "Yes, ma'am," or "Yes, sir," whatever it might be. And they go, "Thank you. Thank you for making this place safe. Thank you for, doing all the stuff that you've been doing to the property." A lot of them have lived there for years and have just put up with it because they didn't want to move or whatever it might be. So that's really cool when you get a lot of that. I also, because I'm an old contractor at heart, I also like to drive by and look one, it's like my legacy that everybody gets to see, right? I could drive by and go, oh, I did that. I fixed that. I did that, right? I made that property better, right? You know, those kind of things. So that's what I truly enjoy. You know, my mission when I take over property are two things. My mission is the kids, and my mission is those old ladies who are too scared to walk out of their apartment. Those are my missions. And so my job is to kind of make the community safe, so the old ladies are okay with walking outside of the apartments and they're not scared. And then the kids have a nice place to play, right? And they're safe, and their parents don't worry about it. And when you do those two things, if you take care of those two community groups, you build a sense of community there, right? You build your community is a nice place to live, and that's what you want to do to get people to stay. So that's generally kind of how my kind of mission and kind of what I do on a day-to-day basis. So yeah.
I think that's awesome right there. So what is a no for you as far as like when you do a walkthrough of a property? Because you go from slumlords and things like that, but what is a no? Like I just can't do this.
So a no would be like, I'm not scared of foundations. I'm not scared of roofs. I'm not scared of any of that kind of stuff. But at some point, when sellers either intentionally or unintentionally have lied to you about the condition of their property, and you get into it and you realize, I mean, the numbers have to make sense. Like at the end of the day, it has to make sense, right? It has to pencil, because if it doesn't pencil, you're not going to be able to improve the property the way you want to. You're not going to be able to do the things to make the community better if you're always struggling because it doesn't make any sense, right? So, I've walked away in due diligence from properties where the condition was far worse than I thought it was originally, because you just couldn't tell. Like if you're going in and looking at a building that has stucco in the exterior, you can't tell if that sucker's got foundation issues. You just can't, because stucco floats, right? So it's always going to look level, right? So you get into a property, if it's got stucco on the exteriors, then you've got to walk every unit and take the foundations guys got to get in there and look at them. And you know, if it's like in Houston, Texas, you know it might have foundation issues, right? So you got to walk every single one. But I had a property, it was like 232 units, and I had to walk away and due diligence because I knew one foundation issue on one building, but half of the buildings, like there was 14 buildings on the property, 7 of them needed foundation work. Wow. And it just, at that point, it was too expensive. I couldn't cover. It wasn't going to make sense to do that property, right? So I will walk away from stuff if it doesn't pencil, right? You just always uncover stuff, and thank goodness I've been a GC enough to know that I can have a fairly good eye to catch most stuff. So I don't generally get into stuff where I can, like, if I get in my due diligence, I generally know walking in what I'm going to walk into. But that was definitely eye-opening, because all those properties were the exteriors were stucco, and you just couldn't tell. You just couldn't see it. Like it was just the weirdest thing until you walked inside the building to know, which was really kind of interesting. But yeah.
I mean, it's a good point right there, that you're looking at the property and you gotta do your walkthrough, because you just never know what is right there. They can talk to you all you want, but pictures can tell you one thing, but looking at the property is totally different. So I definitely understand that.
Yep.
So, in your journey, and I'll get to your deals in a minute, because I definitely want to talk about your latest deals and things like that you just completed. But in your process, in your journey, what has been one of the biggest learning points for you along the way, since you became a GC and things like that?
So like going from a GC to a sponsor and understanding that whole process, scaling from single family to multifamily was one hurdle initially, right? And then going, and then learning the whole craft and mastering my trade around being a full-time sponsor and all that. That was also another hurdle. You learn along the way that as you get into more and more deals, you have to have, the biggest lesson I can teach people is that you have to have a team. And I know everybody says, oh, I'm going to go build my team, but they're not really building their team. they're finding partners that are going to work with them on an occasional basis or whatever it might be. They might go find their attorney. They might go, find a realtor, broker, find them deals, whatever it might be. But they're not really building a team. When you're at the commercial stage, you really need to have people working for you. Because if you're going to go raise money from anybody, like whoever it might be, you cannot be, and I did this, so this is coming from experience. Y'all learn from me because I did this and I screwed up, right? You cannot be the only person running it. You can't be the person that's the property manager, that's also the accountant, that's also the investor relations person, there's also this, that, and the other, right? You cannot, sustain that, nor should anybody expect you to sustain that. Those are all full-time jobs, right? Being the investor relations person, being the accountant, being the asset manager, being the sponsor who put the deal together, right? All of those things are full-time jobs, right? And so you have to have those things outlined, and you have to have people working for you, whether it's a partnership agreement or whatever it might be, that are on your team to take care of that stuff, right? Because no joke, you should not, your financials should go out on time. They should go out on time to your investors, right? I don't care if you're sick. I don't care if you've got COVID, right? You need to have somebody on your team that's going to make sure. Now, if your whole team went down with COVID, okay, fine. But you need to make sure that you've got systems in place and backup systems in place that the investors don't feel it, right? Because that's your job as a sponsor. So a lot of people don't get it. They'll get into their first deal, their multifamily deal, they'll go raise money, and they'll try to do it all on their own. And, I did it, y'all. Just don't do it. Go find partners to work with you that can help you get all the work done, because you will thank me later. And please send me a bottle of whiskey. Glenlivet is my favorite. Glenlivet 15-year. When you realize that I just saved you all this heartache and pain and all this other stuff, just send it to me. Okay. I get bribed in whiskey, the same. So yeah.
Love it. Love it. Love it. Love it. Y'all send her a whiskey. All right. The next thing, and I think it's a great point you made, but the next thing is you have mostly did all your deals in Texas, right? For the most part. Why is that? And I know you're trying to go outside the state. Why is that as well?
I follow opportunity. So if an opportunity presents itself and it makes sense to me, I'm not going to not do it, right? So I've built up my team to this point where, I can chase opportunities, right? And that's where everybody needs to get to be, right? So you will, as you scale and as you grow, if you go from one house to another house and do all these great things, my advice to you is, if you go flip one house, whatever money you gained from that, go turn it, because you don't want to pay the tax man, right? Go turn it into another real estate deal as best you can. Go reinvest that. Reinvest a lot of your money initially, because you will, in 3 to 4 years or 5 years, you'll be much further ahead than the people that flip the money and partied with the money, right? Or they wholesaled a bunch of stuff. You need to reserve back your cash, especially right now, because there's going to be deals coming on the market. Maybe not in Austin, Texas, because this market's just an anomaly, but you're going to cash is king. And if you're deploying it out into your real estate and you're not managing your cash, you're going to miss opportunities that are going to come across your way that are probably better than whatever you have your crap deployed into. Does that makes any sense? So please do not deploy all your cash. It's a business. And in order for you to scale, you have to have cash reserves. You have to have that stuff. And you can't just be, oh, I'm a real estate investor, so I'm going from one project to the next project to the whatever. No, you own a real estate investing firm. And that real estate investing firm has marketing needs. It has administrative needs. You have tax returns, accounting needs, all these different things. So you need to make sure that you have a cash basis to run your operations of your firm. And then you also have the cash to go invest whatever it is you wanted to invest in, if that makes any sense. If you aren't doing this full time, then you need to have a secondary sense of source of income. Sorry, I can say that. secondary source of income to kind of help float you, right? So we had our construction company initially. We were real estate investing. We also had our construction company. So that helped. That was very beneficial at the time because we had that secondary source of income. And so that was helpful. But if you're going to go and do this full time, then you just got to manage it like a business and do those things. So as you transition and grow, cash is always going to kill you. If you're trying to go from one opportunity or chasing one opportunity or another, you always need to make sure you're managing your cash. And if you get really good at managing your cash and your cash flows and all those things, you will scale a lot faster. So I look at opportunities. I have the ability to kind of understand what my revenue is going to be and my fee revenues and where I can, and it maybe not be your cash per se, but you need to have access to it, right? So it might not be you're actually forking over the money to put the earnest money down to get the deal done, but you've got somebody who's willing to invest with you to do some of that kind of stuff, or you network with people, but cash is always key. And that's what's going to kill you early on and later on. Like as you scale and grow, you're always going to come across, like I've been through 3 levels of cash crunches, right? And that's like along my journey. And so you just learn how to manage those better. And that's always key. And then I think the other thing too is marketing, right? Your marketing, we have like the same marketing consultant person. It is so beneficial for you to run this like a business, and marketing is one of those key components. And if you are not marketing yourself, you're doing yourself a disservice, right? But you want to market yourself not like, look, you don't want to be a used car salesman, right? Nobody wants to do that. Nobody wants to be the guy screaming at you on a video, right? Like, who wants that crap? Who's going to resonate with something like that? So, but you do need to put out content where it does resonate with people. I think that that's always beneficial. So marketing is key. Cash is key. Finding the right partners to partner with you. You can't hire them, then partner with them and give them enough into a deal to where they can partner with you and pick the right partners. That would be kind of the key highlights for me. If that makes any
sense. Jordan asked a question. What was your most difficulty transition from residential to multifamily?
Understanding the financing game and what it required. You think you get into it, and you think getting a loan on a single family property is hard, right? Try to get into a multifamily. Getting through the first transaction was difficult, and learning all those pieces and how all those pieces flow. If I count the number of people, just different people that are involved to get an actual commercial real estate transaction done, it's probably about 20 people, no joke. And you're managing all those pieces and understanding, like, you've got the lender and the lender's lawyer, and you've got your lawyer and your SEC. If you're raising capital, you got your SEC attorney, right? So that's 3 lawyers. And then you've got like your insurance person and your surveyor and all the third party people that your lender's supposed to call. And they may or they may not call, depending on how sophisticated they are. And you've got just a myriad of people that you need just to get the transaction done, right? And so the title companies and like all these other different players that are in this deal, that scale and going from single family to multifamily, you'll get blown away at the amount of stuff. Now, I will say, like going to a commercial family loan, in the fact that it's a different ball game and how they lend, right? So, debt to income ratio, I haven't had to worry about that in a very, very long time. Like, no one cares. Like, no one cares about your debt to income ratio anymore, right? Like, when you go buy a single family home, they'll check your credit. And if you're getting hard money or private money, they might not care about your debt to income, right? But they're going to look at the deal and all those other great things. When you get into commercial land and a lot of the stuff that you're worried about, I haven't thought about debt to income ratio and I don't know how long, right? It's all about net worth, liquidity, all those great things to get your loan done. And getting the right lender, right? And you learn over time, as you get farther and further along in these commercial deals, it's not so much that, yeah, everybody's going to quote you and everybody will give you the loan, but are they the right lender for you? I've gotten into a lot of deals where the lender I got was bad. just because of how they service the loan. And not just from a terms or rate, but they just sucked as a servicer, right? Or their insurance requirements are stupid, and I'm doing value add, and the insurance requirements that they're giving me are just dumb, or they're requiring stupid different thing, and I'll spend way too much goddamn money on trying to get a loan done when it doesn't make any sense. So but you don't know that until you get into the game and you kind of learn it. And every new lender's, different, but just saying, I mean, as you get along, you learn that everybody's probably going to quote you close to the same rate. What you learn is to ask the right questions on how they're going to service the debt and how they're going to manage, like, what are their insurance requirements going to be? And a lot of that different stuff so that you learn that you're not going to get killed on your cost side because they're over requiring on stupid things for insurance. And this is like a recent drama. So just saying that I just had to go through that they're going to require these stupid insurance requirements that make no sense, right? Because they're required of everybody. But you just learn as you go. And I just learned that lesson, y'all, like last month, just saying. So yet it's always new. It's always challenging. So just saying. Yeah. So
Right, Chantel. Was assurance. So let's get into deals. Let's talk about deals. Right. So you just completed a deal.
I did.
In Houston.
Yeah.
How was that experience, and what was your pain points for that?
How much beer do you have, Aaron? This is at least a 3-beer conversation. I'm just saying. Like, some are just 2 beer conversations, 1 beer conversation. This is a 3-beer conversation. So y'all all go get your beer. No, it is. Like, it was insane. This project took forever. We had to restructure it several times. Like, it was nuts. I had to, like, on the last, okay, so let's start from the beginning. We got this sucker under contract in July, right? July of 2021, right? And we were going through the deal. We went through due diligence. We found that the seller was a knucklehead. We went back, renegotiated, all these other things. And then we get into there, and then we're having to do an extension, right? The first extension number 1. And we're like, well, you jackass told us this was 228 units. It's really not 228 units. It's really 227. So we're going to negotiate and extend. And we're going to drop the purchase price because you said it's 228. It's really not because you lied, right? So then that's number 1. And then we get in there and we're looking through stuff and we're having, like, we're raising equity and we're doing all these different things. And these are older properties. So, I buy old, so it's okay because I buy ugly. But there was a lot of stuff that the seller either didn't know or didn't care to know or didn't pay attention to. All these great things. So as we're uncovering these under our due diligence, we're like, whoa, holy crap, what about this, right? And so we kept doing several extensions, and then we're ready to close. Like in December, we're like, okay, it's on like Donkey Kong. We're going, right? We're going to close. And the seller goes, oops, it's December. I'm going to have a huge tax bill in April because I'm closing this in December, right? And can y'all push it a month? Can y'all extend it a month? Because we really don't want to close in December because we're going to have this huge tax bill because apparently we don't know how to exit, do 1031s or do, Delaware statutory. We don't know how to do anything. So we're going to ask you to push it a month. And we're like trying to be accommodating. And so we're like, okay, we can push it a month, right? That's fine. And because, we were just being good because the seller had been good to us. They extended it a couple of times. So we're like, okay, we'll extend it, right? Well, unbeknownst to us, when we did that, one of our largest investors went, F you, I wanted to close this in 2021. I wanted the write-off in 2021 because I have all this goddamn money. I'm counting on you to give me this write-off. And they got pissed off and they took all their money and they went 8 ways, right? Which was a lot of money, which now we can't close the deal, right? We can't close the deal like we thought we were going to close the deal. Syndicating so much fun. Anyway, so I'm like, well, holy crap, what are we going to do? So then in January, we go get another investor to come in, another investment group, and they're coming in, and they're like, okay, we can bring in the money. We've got a tick. We have to do this stuff. We have to do all these great things. We promise you we'll bring in the money. So we got it. We got a new GP group. They came in. We explained that to the seller. Hey, you screwed us. So now we got to figure this out. So we got a new GP group. But then, so like in December, no, in February, sorry, my math's wrong. In February, we're getting down there. We're trying to close it. And the seller, by this now, realizes that the contract price that we have this on is probably $20,000 a door less than what he could get it if he just got out of this contract and put it back out on the market, right? So we're now in February. We've done all this work. He screwed us in December. He did all this other stuff, right? We're in here and like he's hemming and hawing. I'm like, we really need you to sign an extension because of these reasons, whatever it might be. And he's hemming and hawing and doing this. And he's like, you know what? I'm not going to extend. And we were about to lose. I was about to lose my face mud about 400 grand, right? I was about to lose $400,000 on this deal with the extension monies, the EMDs, all this other stuff. It went hard. I was about to lose $400,000, which was not nice, right? So I turned from fun Amy into mean Amy. And I went and found like a loophole in the contract where he like right before you close on a deal, if it's been hanging out that long, what you do is you go back and redo your due diligence, right? You go back and do it just in case anything like weirdo comes up and you need to know, right? So I did that. And because I did that, I found that there was an insurance claim that happened that he didn't notify anybody about. It was a slip and fall claim too, because those can get really, really expensive. And oh, by the way, he didn't bother to tell anybody. Right? So now he's in default of contract. So I turn into mean Amy. And I'm like, you motherfucker, and you better extend and all this other stuff, right? And it was the last day, like February 28th, whatever it might be. And so what we did, all these things, right? So what I did was I had, like, in the last 2 weeks, I'm like, okay, I got to close this deal. I'm like, first of all, I am not losing this deal because I would lose 400 grand. Like that would suck. And so what I did was I actually went out and found a lender who would come in, good friends of mine. They're in Houston. They would come in a pinch and they committed to me that they actually could close it in 2 weeks. So I did find a lender that could actually float the loan so we could get through all this mess. So they were going to come in with $15.4 million, y'all, and they were going to help me close this deal. And I was going to have to pay them all these points and all this other stuff to get this deal done because these motherfuckers were not going to extend this deal, right? Because he was going to walk away with a lot. He's walking away from a lot of money, right? Because he knew he could turn around and sell it, right? So I got a lender to come in at the last minute saying, yep, Amy, we'll give you the $15.4 million. And I got a term sheet from them. I got this in. And so I call on the call last day going, okay, you know, you're a jerk. You know, you didn't tell me about this deal, right? And I'm talking to the sellers on the last day. The lawyers, it went from the lawyers are fighting back and forth to finally I got on the phone with the seller and the seller and I are talking. I'm like, okay, let me tell you what you did to me. And I explained the whole story to them. And I said, oh, by the way, but I do have a lender who's going to get us to close. And if you don't extend, if you don't extend, not a problem. I'll get this loan done, but I'm going to have to pay them so much in points. So either you can get that money or I can pay this to this other lender and we will close. Like basically that was my story to him. And they came back and said, we'll take that extra money. So I ended up giving them whatever I was going to give to the points, the other lender to extend. And then we extended it. And then we got through all the other rigmaroles. My insurance costs went up like crazy. All this other stuff happened. But y'all, I'm telling you, we did our initial pro forma on this deal back in July, right? And then we updated it back in September. And then because of the multifamily rents, I'm like, we were performing lower rents. And all of a sudden, we closed on that. We just did our post. So after you close on a deal, we basically, you do a post-closing pro forma. Like you go back and you go, okay, well, we know what those costs really are now, right? Because we just closed. So you go and update your closing costs, you update your business plan, you do all those things. And with all of the extra costs, paying the seller, paying the extra insurance, like don't get me started on the freaking insurance. It was like double, y'all. I'm like all these different things. We still, because we're able to raise the rents to where I thought like even higher, we're going to hit our year 3 numbers in year 1 because it's based off of what current market is. So because we're able to hit year 3 numbers in year 1, my pro forma will still hold, even though our expenses are probably a good third, like maybe maybe at least a third higher. They're at least a third higher, 33%, maybe 40% higher, just because we weren't expecting on the insurance and some other stuff. So it's really an interesting project. Like I said, 3 beers. Like I probably should have drank 2 beers in between now and then. But yeah, and there's more. There's even more to that. But that's like the synopsis of what happened on that deal.
Wow.
I'm just saying. Yeah.
Oh man, I'm going to open up for the attendees to ask questions. I got 2 more questions for you.
Okay.
These are light questions, Amy.
All right.
Number 1 is, I first met you in person. The only time I met you in person was in a family office club, and you did a great job speaking. Great. Let me ask you, are you just a natural speaker, or is this something that you have gotten training on speaking?
I will say that it's fairly natural to me, but I was in my other life, I was in human resources. Before I became a general contractor owner, my career prior to that was I was in HR, and I would train. I did a lot of training sessions, but generally they were kind of like ad hoc training sessions or whatever it might be. But no, I have generally been an okay speaker, and just something that I've developed over time. I never professionally trained in it, but yeah. So yeah.
Okay. Last question for me. What is next for you moving forward?
Next for me is a couple of things. So I am creating different investment vehicles for folks to invest in real estate. So we're working on building out my real estate investment company. So to where I will have a fund offering. I will also have a REIT, which is a real estate investment trust offering, which allows anybody to get in. So you don't have to have $75,000 like on my private offerings. You don't have to have that, right? So when I offer out my REIT, then anybody can come in with like $1,000, whatever it might be, right? And they'll be able to. It's like any other REIT. It's a private REIT, but they'll be able to kind of like sell their shares. It's instant liquidity, that kind of stuff. But I want to be able to offer more and more investment vehicles for folks to be able to get into these private investment deals. Because I don't think that there's enough out there. And we all know the stock market's going to tank, y'all. Like, we don't know when, but I would venture to guess fairly soon. Real estate's a very good safe harbor for when stuff tanks, which I know because I started investing during the Great Recession, right? I went through all that, right? I got out of the stock market in 2007 because Goldman Sachs tried to sell off I had stocks, and Goldman Sachs went and took profits on some of my best stocks that I had in my portfolio. And my stock tanked in one day. I lost half the value of my portfolio in one day because Goldman Sachs decided to take profit, and they sold. They sold a big position in it. And because they did that, I was like, I'm never going to let some jerk financial analyst at Goldman Sachs ruin my portfolio ever again. Like, I'm not going to do that. So I just went and said, I'd rather have more control over my investments. So I got into real estate. So that was in 2007. That was kind of the impetus to get into in 2008 to start buying stuff. So yeah.
Yeah, it's a big glare I can see because you like do that and like you can see like a big glare on your face.
I know.
It's all good. It's all good.
Yeah.
All right, guys. So please ask. It's open now for questions to ask Amy. So please raise your hand. Cinto, you're the first person. Please ask away.
First of all, Aaron, thank you so much for hosting. Second, Amy, I love listening to you. You're a straight shooter. That's what not really so much a question. Was I able to connect you with anybody in Chicago? Because I know you were looking for that deal. You were looking for boots on the ground. Did my partner reach out to you?
I think so. I think so. But I have a friend of mine that's in Chicago too. So
Okay.
yeah, we're talking. So that's good.
Okay.
Thank you.
Good. I'm glad to hear that. Okay. Hopefully, let me know how the deal goes.
I will. Thanks.
Thank you.
Movie star Matt, you're next.
Matt. Yeah, hi, Amy. A great chat. I love your delivery. It's just very down to earth. You don't take any crap. So you are very gracious in extending an extension to get the seller to go to the next year. And would you ever do that again?
What I would do is I'd probably take a pulse of my investors first and say, hey, this is what the seller wants to do. Is this going to impact anybody? That's probably my lesson learned there, right? Because I didn't have to do it, right? But we just chose to do it. And we just honestly, truly, probably should have asked everybody, but we didn't. And we're just, you're in your deal negotiations and you're doing stuff and just trying to get through stuff. But yeah, we should have, checked everybody's pulse on it first, and then we would have known and would have said, and that would have saved that deal, right, initially. So yeah.
Cool.
Yep.
Thanks.
No worries.
Art, you're up next.
Hey, Amy, thanks for coming on tonight.
Sure.
I just was asking a question, I guess, trying to think of a good workaround for the newer person who would go to the property to do the walkthrough. Wouldn't it be a smart idea to bring a property inspector, or do you see that not being feasible based on cost, or what's your thoughts on that?
When you do multifamily due diligence, I have a whole slew of people that come out there. So yeah, there's cost to it. So I always have a plumber come, I have a foundation guy come, I have a roofer come, I have a GC come, and they all charge me. It's a part of what you do. And even though I'm a GC, former GC and all those great things, but I can't, x-ray the pipes, right? So you need to camera the lines. You got to do all those great things, right? I wish I had Superman's x-ray vision. That would be cool. But I don't. And so, yeah, so they have to camera the lines. They have to, and I can tell if roofs are bad, and I can look at, fascia and soffits, and I can look at generally, and I have fairly good sense if it's like it has foundation problems, but I still want them to come look and do their due, it's a part of it, right? I do, as a sponsor, have a fiduciary duty to my investors to make sure that whatever property we're getting into, I'm doing all the right things, right? I got to make sure that the investment that I'm offering them is a good investment. So you do all those things, and you dot your I's and cross your T's and make sure that it's good. So there will always be upfront costs to due diligence, which is, a part of your job as a sponsor, right? You front that stuff. And what you might do is you might front it, like in that one deal where I walked away from it, all those costs I had to eat, right? I didn't get paid back for that stuff, right? So that's what everybody's like, well, why are you getting paid so much in acquisition fees? And I'll tell you, because I walked 10 properties before I got to this one. I'm offering this investment to you, but I have a business and I've been eating due diligence crap for ever, right? So it's a part of why there's acquisition fees, right? It's part of all of those great things. You're running a business, and and so everybody complains about the fees, but y'all, we're not partying with the money. It's this is a business. There's fees are for legit reasons, just FYI, right? And so it's always kind of an interesting conversation you have with an investor.
Okay. And another part of that question is, if you go into a new market, how would you source the people that need to do that for you?
Okay. So this is a great question, because I used to do this all the time. So when I was a GC and I was in 16 states, no joke, I would be doing a job in St. Charles, Missouri, and I'll have my guys that do the drywall and the carpet and the paint. They would float around everywhere, but I had to go get the electrician. I had to go get the plumber. I had to go get the HVAC guy, right? And they didn't know me from boots. They didn't know me. They who the hell are you, right? So what I would do is I would source some of the vendors, right? So I'd call their suppliers. So There's a lot like Ferguson. They're a large plumbing supply company. And I had accounts with them in Texas, but they're like kind of all national, right? So I would call the local person dude going, hey, I got a job. I'm not there. I need a good plumber. Who do you recommend? So I call the supply houses. And when you call the supply houses, they know who the good plumbers are because they interact with them every day. They know who's knowledgeable, who's not knowledgeable, plus who pays their bills, right? All of those great things. And they don't mind floating you a couple of names of good plumbers, like who their buddies are. But
That's a
it's
good
not a bad,
idea.
yeah, it's not a bad way to do it, especially if you're not in that market and you need to find people. Local real estate investor associations also will help you. You know, people like to always refer people. It's like, I don't know what it is. They get a kick out of it, like it's power trip, whatever, fine. But they always like to be able to refer people. So you'll get good people that way. You just gotta manage them. And I was always managing contractors from afar, so it's something I learned to do when I was a GC. But then once you get one tradesperson, like no joke, you go find a good plumber. He's gonna know you're a good HVAC person. He's gonna know you're a good electrician because they all drink at the same damn bar, right? They just do, right? Or they hang out at the
Okay.
same picnic, or they go to church together, or whatever it is. They all hang out with one another, like or they're on multiple jobs together, so they know who the good ones are, right? So once you get one good MEP guy, like if it's a plumber, electrician, whatever, and they might know good drywall people, so they'll help source some of that other vendors for you, especially if you're in a new market, you're trying to do something. That's how I would do it. So just saying.
Okay, good advice. Thank you so much.
You're welcome.
Desmond, you're up, sir.
Okay, thanks, Aaron. Thank you, Amy. Great presentation. Thank you for sharing your experience. Question, is your goal or exit to refinance and hold or sell?
It depends on the property. It depends on the market. It depends on my investor preferences. So when you walk in, I will give my investors, like, our anticipated hold time is 5 years, right? Do we have to hold 5? Nope. We could sell in 1, we could sell in 2, we could sell in 7, we could sell in 10, right? So there's a whole lot of market conditions that go into play in that arena, right? So, but generally I will perform it out a 5-year hold. I always, since I'm value add person, I generally what we'll do is we'll go in and we'll force appreciation. So we'll go in, we buy ugly, make it pretty. So we'll do the capital improvements to make it pretty. We've increased the value to some point, and then we'll refinance out. I mean, the debt that we're in initially is not the debt you want to stay in long term, right? So it's bridge debt that's covering part of your construction costs, similar to like a hard money loan in single
Right.
family. So very similar. And so you get bridge debt to cover part of your construction costs, part of your overall costs, and your acquisition. And then you get out of that debt like you do in single family into
Right,
sort of
refinance.
debt. Refinance, same concept. So in multifamily, what you do is when you do that, you've built up so much appreciation that sometimes, depending on how you bought it or where you bought it at, you will have you can profit sometimes from the refi. You can return a lot of the investors' money back to them, right? That's the whole goal, right? You want to force appreciation to where your value is so high that where you bought it at, plus all the money you put into it, plus what an investor has put down, that when you refi out, they can get a lot of their money back and still be in the deal, right? So that's the whole goal when you're doing a lot of these deals. So generally, I try to refi in year 1 to 2, depends on the terms of the loan. Like some of the loans, I'll try to get out in the first year. Some of the loans are at lower interest rates because we have a longer CapEx project, like Pasadena. It's like the CapEx is no joke. It's like $2 million, and it's going to take us about 2 years to get through it. But some of the Corpus Christi ones, that's smaller, and we're going to be done with that CapEx probably in about 6 months, right? And so I'll get out of that loan as quickly as I can because the bridge is higher interest, all those things. So it just depends on a lot of those factors, that you manage the projects to make sure that you're maximizing the returns, and your interest payment and how your loan terms really determine what that ends up looking like for your investors, right? So you got to be really good at managing debt, when to get in and when to get out, how long you have to hold, all those great things. right?
Right, because your initial percentage and the initial investment amount is lowered once you refinance, which you could give back maybe 80 or 75%. So they still stay with that same percentage. Did you negotiate that in the beginning?
Oh, no, they keep their same ownership percentage. It's the coolest thing ever. So y'all, when
Okay.
like you go in a multifamily deal and your initial investment, say you own 2% of the deal, or 5% of the deal, whatever it is, right? You own whatever percentage it is based off of your ownership interest. If I come back and I refi the deal and I give you all your money back, you still own 5% of that deal. It doesn't change. And so even though you returned your capital to you, I'm not buying you out of your ownership interest. Nope. You still get checks. And the coolest feeling, I know Aaron talked to me about this earlier, but the coolest feeling is when you give somebody a check, you're giving them a check and they have no money in the deal anymore. That is like that. I got mine back in 2011 on my first investment when I got my first check when I had no money in the deal. I cashed it, but I took a photocopy of it and I framed it because it was the coolest, no joke, the coolest thing you will ever feel in your entire life. Because you're like, holy crap, that's powerful. I still own this, even though I got all my money back already. I still have ownership in this deal, and this mailbox money that I'm getting is based because I chose to invest in something, right? It's life changing when you get those checks. It's like really cool. It's
Thank
really,
you.
really cool. You're welcome. It's really cool.
Jordan, you up next, sir.
Just everything that you've been saying has been gold. So appreciate you for being on. As far as making that transition, because that's kind of where I am now. And you mentioned building a team. Building a team is pretty expensive on the front end. How are you building your teams, and I guess also affording it, let's say prior to getting into some of these larger deals? Because just hiring an accountant, that's baseline. If you want to get a good one, and you're talking about 70 G's or something like that. If you're talking about hiring full time, and then all the suite of other positions that I'm fulfilling now, but really belong to other people.
Yeah. So you learn to structure your deals, whatever your deals are, and I don't know what size deals you're doing, but the property should pay your accountant, right? You should be getting fee revenue to cover your investor relations person. Like, and whatever that ends up being, right? So you have to calculate, okay, my payroll needs to be X, and I need to get so much in fee revenue to cover that payroll, right? That's what you have to do. And so your fee revenue, so like on the asset management side, not property management, because that's not what that is. This is asset management. Like, so on the commercial side, I'll get 2% of income, right? That's an asset management fee. And depending on whatever that income is for that month, I can charge 2% of that income. So I can pay my staff, basically. So initially, when you're first starting out, you don't have it. So what you're going to do is you're going to find partners that want to partner with you. They're bringing us some other thing, but their role is investor relations. Their role, so you're farming it out through partners that are coming in and working with you. And you're willing to go ahead and give up a little bit of the ownership interest because they're your partner, because they're going to take out a very key role to make sure that they do well, right? So that's how I did it initially, was through partners. And then I built up my fee revenue, and that's where I could just hire it. And so that's just kind of what it is.
Got you. So on kind of JV stuff, you retained your ownership equity, and through that equity where you were getting paid on that equity, that's what you had to fund your employees. Gotcha.
Yep.
Okay.
Yeah. It's all about fee revenue. It's all about fee revenue. And as you're growing your real estate investment business, that's what it is. It's all fee revenue, right? And that doesn't mean you go crazy, right? Like, you don't charge all crazy, but fees are justified. I mean, there's a lot of work that goes into it. And lots of times an asset management fee that you're charging on a property ain't enough to cover all the work that you're doing. But but once you get 3 or 4 properties under your belt, then it starts to accumulate, and economy of scale kind of kick in, and then it makes sense. But yeah, I mean, so when you get those asset management fees originally, then you have partners, and you can split it up with them, and then they can, because they're partners in the deal, right? So then they can get compensated some. But on one property, yeah, no joke, it ain't covering it. It's just not covering your time. It's not. So, but you'll eventually get there. Just saying.
Gotcha.
Eat lots of cans of green beans initially, and then eventually, the more properties you get, then you can start eating, pork chops. Just saying.
That's an analogy right there. That's a cool analogy right there.
Yeah, exactly. I was that poor college student where my dinner was a can of green beans. I remember that. That was awful, but it was what it was. Right? I was poor once,
Right.
I was poor.
Miss James, you are next.
Hello, everybody. So my question is, hi, Amy. Thank you for sharing your awesomeness with us while I fix my hair. So I wanted to know, you talked about earlier about making properties safe, caring about thinking about the kids, thinking about grandma. So what are some things, I don't want to say signature, but what are some things that you particularly repair or do to the properties once you get them in order to add value?
Depends on the property. Generally safe means different levels of safe. So if you can gate the property, that's always good, right? Not every property can be gated. I'm just saying they can't. If it can't be gated, then I have become friends with the local substation police chief and have asked them to kind of come and, patrol the area. It depends on how bad it is, right? We've actually had police officers rent a unit and their car sits outside, which is great, right? So we've done that too. So they know that there's a police car in the parking lot all the time. That kind of deters a lot of stuff, right? I've done that in the past. Gating is preferred method. So if you can gate the property, a lot of the cross traffic and people walking through, it just knocks all that crap out, right? It just does. But a lot of that stuff also is coming from your tenant base. So when you start cleaning up your tenant base, right? Okay, no joke, y'all. I've gone into vacants and there were mattresses and needles and the hookers were using the vacants as their place of business. And nothing surprises me at this point. And done all sorts of stuff.
I think we might have lost her.
Soon as she said needles, man, I was like,
Here she comes, coming right back in. Amy, you here? Okay.
I'm here. Sorry. That was such a good story. I had to get out of it. Sorry, my bad. All right. So, okay, I'm here. You there? Am I here? Did I kill it? Okay,
Yes,
my bad.
you're here. Yes.
All right. So I've had to clear out the tenant base, do a lot of that stuff. When you clear out the tenant base, that fixes a lot of things. Because when you get good tenants in there, they kind of become your unofficial police. And so they'll tell you when stuff's going on. They'll say, hey, because they don't want it next to them, right? They don't want that stuff near them. So, so it's changing the tenant base, gating the place, getting a cop to come in and hang out at the property, give him a free apartment to live just to park his car there. I've done that. And then also just generally installing security cameras. I'm doing all those things, right? We do a lot of that on all of our properties and it just makes people feel more safe. So yeah, sorry.
But it sounds like mostly the bringing up the rents, that's what's doing a lot of the value add, right? Have you had to do any major of the CapExes or appliances or any major things to the units in order to bring those values up?
Oh yeah, I mean you have to justify why you're raising the rent, right? So if it's still no joke. I mean rents grew for no reason in the last year or two, and they'll continue to grow. And so you can push rents a little bit, but generally you like to walk in and say, hey, we're doing this and this and this and this and this to this apartment complex. Therefore, when I renew you, it's going to cost you $100 more a month, you know, those great things. Or we can say to the market, so you got to compete with what's out in the market to charge what you're going to charge. So you got to be comparable to whatever the other apartment complexes are doing. And if they've got a playground and picnic areas and a dog park and they bring in Wi-Fi to the properties and they got nice units, well, you got to do the same thing, right? So depending on wherever you're buying it at, you have to make those improvements to justify what you can charge a rent for, right? Similar is in a house. Like if I was going to go flip a house, what I would do is like, okay, I'm buying it at this. Let me figure out what my CapEx budget's going to be. Well, what do? I drive around and look at all the other houses that are on the market for sale. And I would go, well, okay, what do they look like on the inside? Because that's what I'm competing against. So same concept. You just walk around and look at all the other apartment complexes and you shop them and go, oh, they're offering this and they're having that and they're having this. Okay, so what do we need to do to improve ours to match that so we can charge the rents that we need to charge to get our returns that we're trying to get? So yeah, same kind of concept, just larger scale. So, yeah.
Thank you.
You're welcome.
Okay, so Amy, do you have time to stick around or?
Yeah, I do.
Okay,
good.
so cool. Okay, so we can end this meeting right now, but please don't leave, guys. Amy will still be here. I just want to thank Amy once again for coming on here and just providing so much knowledge and gems to the audience. And also next week, our guest speaker will be Clyde Davis. So another great speaker right behind Amy. And also at the end of this month, we are going to start the Veterans Transition Speaker Series. We're gonna have a gentleman talk about government contracts. So if you know a veteran who might be getting out or is in the military, might want to learn about government contracts, please swing them my way. We're going to do this every month up into the grand opening of the Veterans Transition Speaking Series. So more to come. All right, guys, I want to say once again, thank you so much. And we'll see you next week.